So, good morning, my fellow economists, researchers, and policy experts. Welcome to another OEA and CABE event. CABE and the chapters are honored to host the bank for this national event. So, my name is Bolanle Alakiakpata. I'm the president of the OEA. So, a couple of announcements before we get started. During the presentation, please feel free to drop your questions in the chat. And after the presentation, I will read your questions to the speaker. So, we will do our best to answer as many questions as possible. For those attending in person, when prompted, please state your name and your affiliation and ask your questions. I will try to repeat your questions for the speaker. So today we're here for a presentation on the bank's use of exceptional monetary policy tools in the COVID-19 pandemic. So we're focusing on from quantitative easing to quantitative tightening. The presentation will also touch on the importance of public accountability in times of crisis and beyond. So to discuss the topic, we have a deputy governor from the Bank of Canada. So our speaker was appointed deputy governor of the bank in 2021, and she has the responsibility of overseeing the bank's financial system activities and for setting monetary policy. Since joining the bank in 2006, she has held several senior positions. In 2013, she was appointed advisor to the governor and served as secretary of the governing council. She has also led the bank's work on its monetary policy framework in the lead up to the 2016 renewal of the inflation targeting agreement with the government of Canada. Previously, she was an economist with the Board of Governors of the Federal Reserve System in Washington, D.C., and later the vice president and economist of the Federal Reserve Bank of Kansas City. Chiefs, I'm pleased to introduce our speaker, Sharon Kozicki.
I can't tell.
Yeah, apologies.
Well, good morning, and thank you, Bolanle, for your kind introduction. I'm pleased to be here in my hometown of Ottawa and with the Canadian Association of Business Economics and, of course, the local chapter, which is the Ottawa Economics Association. I always enjoy speaking to a room full of economists and business professionals who are interested in the economy. You've long been some of the most engaged consumers of central bank speeches. The COVID-19 pandemic and subsequent rise in inflation have broadened the audience for speeches like this one. Canadians have questions for us at the Bank of Canada, and we want to answer them. So today, my overarching themes will be transparency and accountability. I'll begin by taking you back to the start of the pandemic when the world faced a health and economic crisis like nothing we'd experienced before. I'll walk you through what the bank saw and how we interpreted that information. Then I'll talk about some of the actions we took, particularly our use of two exceptional tools, quantitative easing, or QE, and extraordinary forward guidance. I'll discuss some of the analysis we've done on the effectiveness of QE, which we used for the first time during the pandemic. I'll also go into the unwinding of QE, known as quantitative tightening, or QT, and this is part of the monetary policy cycle. Ensuite, je vais vous expliquer comment on a évalué nos interventions pendant la pandémie. Je vais aussi vous parler de leçons déjà communiquées au public. Et je vais vous dire quelques mots sur le nouveau bilan de nos mesures exceptionnelles et le rapport qui sera publié. Après une crise comme la pandémie, on doit prendre du recul pour mieux agir la prochaine fois. Communiquer nos leçons est essentiel, car le public doit comprendre nos actions et savoir qu'on lui rend des comptes. We have a lot to talk about, so let's dive in. First, let me take you back to March 2020. As the COVID-19 pandemic took hold, large parts of the economy shut down and financial markets were severely shaken. Policymakers here and around the world were worried we would see a repeat of the Great Depression. Confronted with an unprecedented crisis, the bank took immediate action. We cut the policy rate to 0.25%, which is our effective lower bound. We also launched emergency liquidity facilities and programs to restore financial market functioning. And the bank did not act alone. Governments in Canada did their part, as did governments and central banks around the world. By the summer of 2020, financial markets were functioning again. But Canada was still in a health and economic crisis. Millions of people had lost their jobs and were facing the deepest economic decline in decades. Inflation had actually turned negative, and there were worries that deflation would take hold. We didn't have a vaccine at that point, so there was no way to know when or even how the pandemic would end. So faced with the unknowable, Governing Council judged more stimulus was needed to revive the economy and sustainably return inflation to the 2% target. Interest rates were as low as they could go, so the next step was to look in our extended monetary policy toolkit. Two tools were well suited: QE and exceptional or extraordinary forward guidance. Remember, monetary policy is all about shifting the timing of spending to stabilize economic activity. Central banks lower interest rates to encourage spending when the economy is weak, whether it's individuals buying things such as home furniture and fitness gear, or business investing in, say, new facilities or equipment. This spending protects jobs and ensures the economy won't end up as weak as it could have been. But when policy interest rates are as low as they can go, central banks need other tools to add stimulus. That's where QE and extraordinary forward guidance come in. Under QE, a central bank buys a lot more government bonds than usual. This bids up the price of the bonds and lowers their returns, or yields. Lower yields on government bonds pull down lending rates that matter to households and businesses, and this makes borrowing cheaper. Extraordinary forward guidance also helps brings down longer-term interest rates. The way it works is a central bank signals it will keep the policy rate at its lowest possible level until a specific condition is met or for a specific period. And typically, that's longer than financial markets would otherwise expect. L'assouplissement quantitatif et des indications prospectives exceptionnelles réduisent les coûts d'emprunt. Ça fait augmenter les dépenses et réduit le risque que l'inflation soit inférieure à la cible de 2%. Ces mesures exceptionnelles peuvent aussi avoir un effet à travers le taux de change. Quand les taux d'intérêt canadiens sont plus bas, certains investisseurs sont tentés de placer leurs fonds dans d'autres monnaies, ce qui peut déprécier notre dollar et, comme un dollar plus faible est plus bon pour les exportations, ça stimule l'économie. So let's now turn to the effectiveness of QE and extraordinary forward guidance during the pandemic. Now, one way to gauge the impact of exceptional policies is to look at how other interest rates moved compared with our policy interest rate. Here, I'll compare how much 5-year government bond yields fell relative to the decline in our policy rate. So let's consider the last 4 periods when the bank cut interest rates by 150 basis points or more. This was the mid-1990s, the early 2000s, the 2008-2009 global financial crisis, and finally, the COVID-19 pandemic. Keep in mind, we could not lower the policy interest rate as much in the pandemic as in other periods because we were already pretty close to the effective lower bound. Despite this, 5-year yields moved more relative to our policy rate during the pandemic. The pandemic was the first time the bank used QE, and only our second time using extraordinary forward guidance. The higher movement of 5-year rates relative to the policy rate during the pandemic episode suggests these exceptional policies were effective. Focusing in on QE, there are various ways researchers can assess the impact of large-scale bond purchases, QE, on yields. A common method is to use event studies. They look at how much bond yields move at the time central bank purchases are announced. Now, using this method, bank staff estimate the impact of QE to have been almost 20 basis points. That's on the 10-year government bond yield, 5-year government bond yield, not on the shorter term rates. However, the impact may have been much larger. The same study finds that because there was some expectation the bank would do QE even before purchases were announced, 10-year bond yields could have been as much as 80 basis points higher without QE. For context, we would need to cut the policy rate by a lot more than 20 basis points or 80 basis points for it to have a similar impact on the 10-year yields. So this is because the effect of policy rate changes typically fade after a couple of years. So now let me explain why bond yields would have been higher without QE. Early in the pandemic, governments were issuing far more bonds than usual. If investors were to purchase the higher volume of bonds over a short period of time, they would expect higher yields. But the bank's QE purchases meant that investors didn't have to increase their purchases as the bonds were issued. This helped keep yields and borrowing rates for households and businesses from rising. Put another way, the bank's research suggests that without QE, longer-term interest rates would not have been as low as they were. Of course, many domestic and global factors affected bond yields early in the pandemic, and this means that estimates of QE's impacts on yields are imprecise. Likewise, it's very difficult to be exact in estimating how QE affected the economy. Now, bearing that uncertainty in mind, the research I mentioned earlier finds that QE may have pushed up GDP by as much as 3% at its peak. So now let's look at how the economy actually fared during the pandemic. Recall that we were worried about a repeat of the Great Depression. Millions of people were out of work, GDP was cratering, and inflation was well below target. There were concerns that making up lost ground would take years. Instead, the economy recovered relatively quickly. In Canada, vaccines were rolled out widely in the first half of 2021. GDP rebounded and reached its pre-pandemic level later that year, supported by monetary and fiscal policy. Another way to see the impact of our monetary stimulus is to look at growth rates of money and credit. There are many different measures of money. So here we're going to look at M1++. This includes currency in circulation. That's the banknotes in people's purses, wallets, under their mattresses, plus checking and savings deposits. The growth rate of M1++ tends to reflect the impacts of all of our monetary policy actions, including changes to the policy interest rate and our use of exceptional tools. During the pandemic, M1++ grew much faster than in other periods of monetary policy easing since 1990. And that's despite limits on how much the policy interest rate could be reduced. As monetary policy eases, it also stimulates borrowing by households and firms. This shows up in credit growth with a lag relative to money growth. During the pandemic, credit growth also increased, though its higher growth rate was still within historical experience. Together, these data suggest our policies were effective in increasing borrowing. Now, before moving on, I'd like to comment more generally on money growth and inflation. I'm not going to pretend that we got everything right. The pandemic response was challenging. But the evidence suggests that the run-up in inflation that started in 2021 was mainly driven by supply-side issues, including commodity price swings and supply disruptions. When we look at the last 3 decades, we see very little correlation between money growth and inflation. Put another way, money growth has not been a reliable indicator of future inflation. With that said, let's now move on to quantitative tightening. À la mi-2021, il était clair que la reprise allait plus vite que prévu. L'inflation dépassait 3% et se répandait. Il devenait nécessaire de durcir la politique monétaire. En octobre 2021, la Banque a été la première à mettre fin à l'assouplissement quantitatif. En mars 2022, elle a commencé à augmenter le taux directeur. En avril, le resserrement quantitatif a débuté. Résultat, la croissance de la masse monétaire a ralenti puis est devenue négative. Let me repeat that in English. We started raising the policy interest rate in March 2022, and then in April 2022, we began QT. As monetary policy tightened, money growth eased, and then money contracted. That's the dip you see at the end of this chart. When we started QT, we said we would let bonds roll off our balance sheet as they matured and not replace them. This would allow our balance sheet to shrink predictably and has allowed government debt holdings to shift gradually from the bank to the private sector. Since we began QT, our Government of Canada bond holdings have declined by as much as 45% without disrupting financial markets. QT also proceeded smoothly through the tensions in the U.S. banking sector in the spring of 2023. We expect QT to end sometime in 2025, which would also make us one of the first central banks to wrap up the normalization process. So why has QT been so smooth in Canada? I like to think it's because we've been transparent. Information on our bond holdings and their maturities is publicly available. And we've been providing regular updates to the public and market participants on where we're going and our progress in getting there. So that brings me to transparency and accountability. So again, let's go back briefly to the beginning of the pandemic. Try to remember just how little we knew about the virus and how it affected our lives and the economy. In those early days, there was simply too much uncertainty for our standard analysis, and that's exactly what we told Canadians. We didn't provide a base case projection in the April and July 2020 monetary policy reports. Instead, in April, we outlined various scenarios of how the crisis might play out. And in July, we used a central scenario to explain our assumptions about the pandemic and the economy. In both cases, we were clear about what we didn't know and about the range of possibilities we were considering. We were also transparent about the actions we were taking. Now, as the pandemic progressed, we began to reflect on the effectiveness of our policy decisions and other actions. We shared those findings with the public. In the July 2020 Monetary Policy Report, when inflation was near its peak, again, above 8%, we detailed the main factors behind our prior inflation forecasting errors. Now, I want to highlight two key points about this. First, we did this work at a time when prices were still climbing sharply. In essence, we were reviewing our actions in real time. And second, we didn't wait until the crisis was over to share our findings with the public. We put them out as quickly as we could. We did this because we wanted to be transparent with and accountable to Canadians. In December 2022, Governor Tiff Macklem spoke in detail about the lessons learned from the bank's experience with unexpectedly high inflation. He also touched on how those lessons would shape our decision-making process going forward. In March 2023, Deputy Governor Tony Gravel gave a speech assessing the bank's market interventions during the pandemic. His remarks drew from a detailed review by staff of the emergency programs and facilities the bank used to restore market functioning. Over the course of 2023, my colleagues and I continued to speak frankly about what we were seeing in the data and our takeaways. In his year-end speech, the governor updated Canadians on how we were applying pandemic lessons to our work. And he detailed how the bank was enhancing its models, surveys, and analysis to sharpen our future responses, particularly in times of uncertainty. As well, I'd be remiss not to mention that my remarks today draw on research and analysis by bank staff throughout the pandemic. This work is crucial to building our understanding of how the economy acts in unpredictable times and to ready us for the next crisis. So where are we now? Higher interest rates have worked. Inflation's now below 3%. We're seeing more signs that underlying price pressures are easing. This makes it a good time to take stock of our pandemic response from the macro point of view. As I mentioned earlier, we're putting together an in-depth review of all of our exceptional actions taken during the pandemic, including the market functioning programs, QE, and extraordinary forward guidance. This review will draw on analysis that's already done and some that is in progress. It will lay out our lessons learned, including some we've already shared, and identify questions that will guide future work. It's important that we learn from our own actions, but it's also important to get other perspectives. Therefore, this review will be assessed by outside experts. We expect the final report to be published early next year. While this review is a significant step, it's not the final word. Questions will continue to be asked that may shape if and how we use our exceptional tools in the future. These questions are particularly valuable in a world where the next crisis may look different from those in the past. To wrap up, the pandemic was a period defined by the unknowable. Uncertainty was particularly high, so the bank took a risk management approach to decision-making. We considered alternative futures and thought about consequences of making policy errors. Governing Council then chose a policy course that accounted for those risks. D'après nos études, nos mesures exceptionnelles ont fait baisser les taux d'intérêt à long terme en renforçant la détente monétaire, même après la forte réduction du taux directeur. Le passage de l'assouplissement au resserrement quantitatif s'est bien déroulé jusqu'ici. Ne l'oublions pas. Quand on a opté pour l'assouplissement quantitatif, on était devant un choc sans précédent. Donc, il faudra un événement majeur pour y revenir. So let me repeat that. Our research into our use of exceptional tools during the pandemic suggests those policies helped lower longer-term interest rates by increasing monetary policy stimulus even after the policy rate was brought as low as possible. The unwinding of QE through QT has gone smoothly. However, it's worth remembering that we faced an unprecedented shock when we decided to use QE, and the bar for us to use QE again is very high. Last week, we cut the policy rate to 4.75%. If inflation continues to ease and our confidence that inflation is headed sustainably to the 2% target continues to increase, it's reasonable to expect further cuts. But we are taking interest rate decisions one meeting at a time. It is comforting to see inflation come down. It is alarming that it rose so much. Our focus now is on the lessons we can take from our pandemic experience and how those lessons will guide the future application of monetary policy. So thank you for your time, and I'm happy to take any questions.
Another round of applause for the Deputy Governor, please. Okay, so do we have some questions in the chat?
In person.
But I want to see the questions. Can we project the questions? So while we're doing that, I'll ask my first question. Might as well start, right? So, Deputy Governor, some economists have raised the alarm about stagflation trends in Canada. Some have even argued that they don't think that we would have soft landing anymore. So in your opinion, do you think the economy could still achieve a soft landing? What would you need to see?
So I think first off, when we think of stagflation, we think of the 1970s. So that was a period of weak growth, recession, and very high inflation. So I think the primary risks around stagflation are behind this. What do I mean? We have inflation come down a lot. Monetary policy has worked. Inflation is now below 3%. It's not back on the target. Still some room to go, but we're out of those particularly concerning high levels. The other side of the stagflation is the weak economy. And we had some softness, right? The economy did not grow very strongly last year. And the last 2 quarters were pretty much stalled. As we look ahead, we're expecting more improvement on the growth, from the growth point of view. And you can see that in our April monetary policy report, that we're seeing more solid growth, and we're seeing more solid growth in GDP per capita as well. So that's getting that more improvement in a sense for each Canadian on average, as opposed to a period where the softness was affecting many people.
Okay. Thanks for that. So do we have questions from the audience here? Please, go ahead.
Retired trade commissioner. Just a question of other jurisdictions around the world and how they handled this issue of inflation. We were sort of not in lockstep, but consistent with a lot of the West. But just having the Chinese in mind and what they did, they really went after dominant market presence, competition policy. There's been echoes of that in the U.S. just recently. Different economy, a whole bunch of different reasons, but my nagging concern the whole time through this is how much was really solved by high interest rates and how much was solved by getting after dominant market presence. It didn't really seem to happen here, but it did in some other jurisdictions. So it's, you can riff on that. My sense is, allay my concerns, or maybe there's more to it.
Yeah, so let me take a step back and again talk a little bit.
Would you like me to repeat
Oh,
the
yes,
question
sorry.
again?
We'll repeat the question for
So
those
just
online.
to repeat the question for those online. So the question is about inflation in other jurisdictions and what lessons we can learn, how that was different in Canada. So.
Yeah, and so, we are working in a global environment. We are living in a small open economy, right? And so one of the ways that we saw that play out through the pandemic, inflation at the front end was driven by what was happening in the global economy, right? So we had demand pick up more strongly in some jurisdictions than here. In the United States, demand came back more quickly. We did have, clearly you saw the charts, we did have the Canadian economy come back as well. But in that global economy where you were getting some response in demand, particularly on the goods and the tradable goods side, we also had constraints on the supply side, just difficulties at ports, difficulties getting some parts for production, et cetera. That was part of the reason we saw this big run-up in inflation at the beginning. This is pre-war. When Russia invaded Ukraine, whole other thing. But the other thing that we noticed, and we've talked about this before, within Canada, there was a shift that was occurring around the end of 2021 and into 2022. So we went from a lot of this being global to becoming more of a domestic concern. And that was as the supply side of the economy, which is a little more domestic, the services side of the economy, which is more domestic on the supply side, started having prices start going up. And so overall, it was not just a global story. It was not just a commodity story. There was strong demand. And I mean, if you look back into some of our business outlook surveys, you see that coming through very strongly. The tightness in the labor markets, the firms very easily being able to pass through cost increases, questions about whether they passed through more. That is all classic excess demand environment. And that was not just in Canada, that was also elsewhere. And that was why monetary policy really needed to respond. The other thing is, even if it started off as global and supply side, there's always a concern that that starts getting embedded into inflation expectations. And then that can breed higher price increases, higher wage increases that feed into price increases. But you can just get into a much less manageable situation once you lose that nice firm anchor on inflation expectations. So that was part of the concern as well at the time. It might start global, but it can get into Canada through other ways. So those two things.
Thank you. Do we have a question online?
One online.
So let's just see if I can read this.
From Rob.
Okay. So this question is for Rob. You call the pandemic a time of unknowables. What does the bank anticipate in the time that IEA predicts going forward as a record of oil glut from transition away from fossil for the Canadian economy? So that's from Rob Barnick.
Yeah. So that's a really interesting question, and that's actually touching on some of the highlights that were showing up just in the press, today, earlier this week, about this prediction of record oil glut. Look, I mean, the way that I would say it is more, when we're doing our forecasts, we do look at oil prices and it does feed in. We make assumptions on the oil prices that are usually that things are staying roughly flat, and that's because there's just so much volatility that the flat assumption on average seems to be about right. Flat where things have been recently. And so in that sort of an environment, again, the oil prices matter. Canada is a net oil exporter. This is a big deal. Our economy can benefit from oil prices that are higher, even at the same time as higher oil prices might pass through into higher inflation, right? So we need to be looking at all of this. In the end, we analyze what's going on in global oil markets, we analyze what's going on in terms of oil prices, and then we bring that into our economic outlook. We do run different scenarios on longer horizons, and what I would say there is really we're now in a world where we're trying to think about what is the world going to look like in 5, 10, 15 years. And we have staff at the Bank of Canada working on some of these longer term models so that they can think through more structural types of issues. What do I mean? It could be a transition of an economy towards net zero, right? It could mean a world where there are more frequent and large disruptions coming from climate change. It could mean a world where AI has become much more pervasive and the whole nature of the labor market has shifted. So we're not forecasting those as part of our monetary policy decision, but we have to think about those because we are in an economy of transition.
So is there a question? Toby, please go ahead.
I would like to know how the bank is thinking about its negative equity position. Is it a major source of concern? And when do you foresee, or when does the bank foresee a return to positive equity?
Okay. So the question is, how is the bank dealing with the negative equity position, and how does the bank, and when does the bank foresee a more positive trend? A return to positivity.
So this may be something that some people are a little less familiar with. What does this mean, negative equity position? Well, when we bought bonds, right, we bought bonds at prices that were higher and yields that were lower than they are today. So that means the value of the assets on our balance sheet has gone down, right? And that is a consequence of conducting monetary policy. When we bought those bonds, we had an indemnity from the government to protect us from losses, right? It does not, so again, I think the most important thing for the bank from the point of monetary policy is that the negative equity does not impact our ability to conduct monetary policy. But it is something that is going to be gradually unwinding over time, you know, as our portfolio overall changes. So I can't give you the exact timeline, and part of the reason I can't give you the exact timeline is because, again, the valuation of the assets is going to depend on things like levels of interest rates in the future. And so I can't give you that exact timeline, but yes, it was an outcome of the shift in our balance sheet that was part of our quantitative easing, and it's, yeah, we are not impeded in our ability right now to conduct monetary policy as needed.
Thanks. So the next question is from Jacqueline Palladini. So would you characterize the post-pandemic surge in demand for services as being something that was outside the scope of your initial projections? That is, what is well captured in your forecasting models, or what is just so extraordinary that it wasn't? Interesting.
Yeah, so it's a really interesting question. What became very clear during the pandemic was that looking at the aggregate economy wasn't quite cutting it. Different things. Everyone in this room knows this. Everyone online listening to this knows this. Things were really different. People were not going to restaurants when restaurants were shut down. People working from home were starting to think, you know, maybe I need a more comfortable desk chair, right? All sorts of changes in terms of what people were buying. What does that mean for the economy? Well, that means that the goods side and the services side were not behaving in the same way, right? There was more well, I don't even want to call it cyclicality, because we always have a bit of cyclicality in big purchases that are more interest rate sensitive, but there were just more movements in different directions than usual due to things that were outside of the historical experience. So we started working on tools that could help us capture that information. You know, we're not now thinking about we need to build tools in the future that will do this. We've started work on those sorts of tools. It mattered a lot for prices. We have different models of prices that we developed during the pandemic so that we could do things more disaggregated, goods versus services. then splitting services, shelter, non-shelter, goods, food, energy, the rest. So we started looking at things. It might be bottom up, it might be, you know, piece by piece in other ways, but a bunch of different tools that would help us examine a world that was not as simple as it had been in the past, where we could look at just the aggregates. So I think that's where I would say that in real time, we've been trying to respond to the sorts of challenges we are seeing. We did not anticipate this, right? In July 2020 or April 2020, we didn't think, oh gosh, you know, maybe with this shutdown, suddenly people are going to be spending a lot of money on goods, and we didn't really fully think through this. But we didn't keep our eyes closed to what we were seeing. We tried to keep working to enhance our models, and even without our models, make sure that we were thinking through the logic, applying analysis to what we were seeing and what that might mean, and how to conduct policy in that environment.
Please go ahead.
Andrew Bell with OC Transpo. I was just wondering, sort of two questions. First is this the first time that the Bank of Canada has used the QE instruments? And the second part is, if not, what lessons did you learn before? And if so, what lessons were brought from other central banks?
So for those online, the question is this the first time the central bank has used QE? And if not, what are the questions learned, right? So I think the governor had actually answered that earlier. So this is the second time. But go ahead.
Yeah, so this is the first major time from a macro point of view that we were using QE to enhance just the policy interest rate. We'd used exceptional forward guidance during the global financial crisis. We'd done some stuff on our balance sheet in the global financial crisis that we wouldn't call QE per se. But this time we had not only more stuff on the financial side, but we also had QE. We're not the first bank to do it though.
Yeah,
and so
what you learned from the other groups.
So from the other groups, and you can look online, that we have a number of studies that are actually online that summarize the experiences of other central banks in using some of those tools. I think my name may be on one of those studies even. And so, you know, what are some of the lessons learned from other central banks? So a lot of central banks have done this individually who have had the experiences. A lot of other researchers and central banks have looked at the global experience. We were one of those. So things people have looked at is, how much do long-term interest rates tend to move with a given amount of QE? That's often scaled to GDP because countries aren't all the same size. So that sort of analysis is out there. It can depend on other things that are going on, right? Is sort of the simple answer there. But at least it gives you a ballpark at the beginning to be looking at. Then people have taken those estimates of impacts on interest rates and then put them through macro models to look at, well, then what's the impact on the economy? Again, different models, different countries, different environments, different state contingency for the technical people. You get different estimates, but again, it's a benchmark for starting to think about those sorts of things. So I think the way that I'd answer is, you know, there was a lot of experience from other countries of these tools being, I'll just say broadly, effective with very different sizes of point estimates. And so that's one of the things that as you're entering into it, might be hard to scale. We haven't done it in Canada. We haven't seen a crisis like this. But you're not going into it where no one has ever tried it before. So we did look at that, and there are a lot of studies out there. There was a paper the bank published just this morning that did the analysis that I talked about today. And even in that paper, there's a chart that looks at some of the international experiences with QE.
Okay. So before we take the question from Fanny, we have 2 minutes. So we'll take one more question online, and then we'll take the question from Fanny. That'll be our last question. So this question is from Matthew Sebastini. It was mentioned QT is expected to end in 2025, and the bank will be one of the first central banks to achieve this. Why has this been possible, and are there benefits to achieving this more quickly than others?
So I think, you know, when I think of QE and I think of QT, I think of these as monetary policies. These are counter-cyclical policies. So you want them to end so that should you in a crisis period need to go down that route again, you know, you're in a better starting point. So that's sort of a very simplistic way of saying it, that's why you want to get out. So you have the tool in the future should it be needed. The other thing, and how have we been able to? Well, it's a number of things, right? Again, remember, we were the first central bank to end QE, and our QT schedule has been one where we're just allowing the assets we're holding to mature, and we're not replacing them. So that's what started in April 2022, not replacing them. So now the mix of assets on the balance sheet matters. So central banks that were holding a lot more long-term stuff, either because of QT or because that's what they were holding before, it's hard, their balance sheet's not going to shrink as quickly. So the general structure of our balance sheet in terms of what holdings we have on our balance sheet is one of the things that has facilitated this more quick decline in our balance sheet.
Thank you. So our last question for today, Fanny, please.
I'm going to tie in a couple of questions. Question before from Jacqueline about consumer behavior, basically. The QE has, I know the mandate of the Bank of Canada is to maintain the financial system and also targeting the inflation rate. At the same time, with the QE, with the lowering of interest rate, it also changed Canadian behavior towards loans and debts, and increasing Canadian indebtedness. So, with of all you mentioned all you're measuring the impacts of the QE right now, and studying it. Is it something that we also consider besides looking at how interest, the market responds in terms of interest rate and the performance of the economy? How Canadian right now that they were taking a lot of debts before because of the lower interest rate as a response to the bank's policy. How does that? So first, has it been considered on that side, the Canadian activities toward that, and then how does the bank will proceed in the future to help Canadian now that bearing the high interest rate?
Okay. So for those online, I'll try to paraphrase this. So the question is related to the impact of increasing the rate and on Canadian indebtedness. So Fanny is asking that what happens to Canadians that now have this huge debt now that we're dropping rates, right?
So first, when you think about the impacts of our monetary policies during COVID, you need to also think of where were we before all of that started. Canadians were holding high debt levels prior to the onset of the pandemic. You recall from the global financial crisis on, we had very low interest rates. That is the aberration in history. If you look at the history of interest rates in Canada, it was the period from the global financial crisis on with very low rates was the aberration. And so that period led to a large buildup in debt. With the low interest rates in the pandemic, did we see borrowing increase? Yes, I showed the chart, right? I showed the chart. Yeah, we did see growth of household and business credit increase. But remember, it also increased within historical experience, right? So we started from high levels of debt and we got more, but it wasn't just the pandemic that was the source of the debt issue. It was that whole period prior. And that's part of the challenge now. Right, as we've raised interest rates, the challenge is people that had gone through a very long period of low interest rates. And some of these people, they borrowed this even before the pandemic hit. And that's one of the things that's really exceptional about the pandemic. Again, if you look at that 5-year mortgage contract, every 5 years people are resetting. This is the first time since the 1990s when we will end up having 5 years in a row where people are resetting higher, right? Are we aware of this? Oh, yes. We're aware of this. Yeah. Are we looking at the macro impacts of this, not just the financial stability, because we do monitor the financial stability impacts, the vulnerabilities in the economy. But yeah, we do look at the macro impacts, right? So when people's payments on their mortgages, for instance, go up, they have less money left over to spend on other things. That's softer demand in the economy. That's part of the transmission mechanism of monetary policy. I did give a speech in September last year where I talked about how important looking at the different household experiences have been, in particular, for the pandemic and post-pandemic experience. We monitor it really very, very closely. And so, you know, yes, we look at it. We look at it for financial stability. We look at it in the vulnerabilities. We look at it for the macroeconomy. It's become more important to do that, but not just because of our pandemic policies, because of the prior decade.
So I know you might have more questions, but we have to wrap up. So on behalf of the OEA, CABE, and all our chapters, a special thank you to Sharon and the bank and her team for a great presentation.